What's going on, guys? Welcome back to the channel, and in this video I'm going to share with you how to make money investing in startups. I'm going to share with you a little bit about why you might want to consider investing in startups as opposed to investing somewhere else. I'm going to share with you how the investment process works, how you actually make a return on that initial investment, and at the end of the video I'm going to share with you where you can find some of the best startup investment deals and what you should look for when you're analyzing a startup before you make any kind of investment decision. Now, if you're looking to learn more about investing in startups, I made a few different videos about this topic already. I'll link them in the description below. While you're down there, make sure you like this video and subscribe to the channel if you're interested in this content. This video is gonna be jam-packed. I hope it provides a ton of value, so let's begin. You might be thinking to yourself, why invest in a startup when there's so many different asset classes available? I mean, you can invest in real estate, in the public market. You can start your own business, and I encourage all of those. But today we're talking about startups, and the reason why you wanna invest in a startup, three main reasons. Number one, it is the highest potential return on investment of any other asset class, far and away. If you were one of the initial investors in any of the large successful publicly traded companies today, your initial $1,000, $10,000, or $100,000 investment would be worth 9 figures. It would be worth $1 billion potentially. Think about it, if you were to invest, I don't know, $500,000 in a tech startup and the company was only valued $5 million, you had a 10% stake in that company, and 15 years later, that company would be worth nearly $1 trillion. Think about what that stake, 10% of $1 trillion, sounds like a lot of money. Well, that's an actual true story. That's Peter Thiel's investment in Facebook. Can you imagine investing in Facebook when they were worth $5 million? They're doing more than that per hour right now. So absolutely amazing opportunity to invest in these companies at the earliest stage. And because of that, you can potentially yield the highest return on investment. We're gonna talk about how you can do that. The second is to diversify your portfolio. So you don't wanna only invest in real estate or only invest in the public stock market. You wanna have in an alternative asset class, which is startups, anywhere from 5 to 10% of your portfolio. So if you wanna invest, $100,000 per year, maybe consider investing $5,000 to $10,000 of that into startups. Unless you're a professional angel, maybe that number would be higher, but if you're watching this video, you're probably not. So, a small portion of our portfolio should be allocated just because of the potential disproportionate returns that you can earn by investing in this asset class. And third, and most interesting to me, is the business knowledge you gain when you look at a startup company, because the way you analyze a startup is a little bit different than when you look at a publicly traded company. There's certain similarities for sure, but when you analyze that startup, you learn so much about how the company is actually going to work and what the vision is, and if you believe that this team can execute on that vision. And the way you look at that is way different than a public company, and because of that, you learn new things that you can apply to additional investments in the asset class or in your business life in general. So something to think about. Now, how does the investment process work? So we've all seen Shark Tank, and we see Mark Cuban, and these sharks are, they have the entrepreneur come in and they pitch the idea and they negotiate, and only one investor is allowed to make the deal, sometimes two, and they go in together on a deal, and $50,000 for 20% stake in the company, and the deal is negotiated just like that. And the reality is it takes a lot longer than that, and normally there's a lot of investors involved, and it's not gonna be a decision made in 30 minutes. Normally there's a little bit more back and forth unless you're investing online. You can see a pitch deck, you can see a video, and so the reality is there's more investors, it takes longer, and the terms are normally not negotiable unless you're Mark Cuban or one of the sharks. So normally if you're participating at this level, you don't really set the terms, they're already set. And that's a big difference between the public and private market, because in a public market, the stock price fluctuates by the hour, by the minute, by the second actually. And so you can invest and you can buy shares, you can sell shares at any time you want for profit or for loss. When you're investing in a startup, there's a limited window of time when they're doing the offering, and most of the time, unless it's an open public offering, it's sort of closed doors. So unless you're a professional investor, you don't even have access to the deal in the first place. So the big difference here is timing. When you invest in a startup, you're investing for the long game. You're not gonna be able to sell your position anytime in the near future or in the long run. You're stuck with the company forever, pretty much. Okay, we're talking about a few different ways that's not really true, but you're pretty much investing for the long run. And so in a public market company, you can sell your shares, in a private, you cannot. Now let's talk about investment types. So obviously, if you're investing as an individual, you would be considered an angel investor. there are things called angel groups, where groups of people come together and maybe they go in together on a deal still as individual investors, but they'll collectively each put in a certain amount of money, and the group together will make up, 10 individuals, $20,000 each, and that's a $200,000 investment with those individuals. Now, the third type is a fund. So this is where a venture capitalist or a fund or a firm has raised money from limited partners or other angel investors, and they will make one investment on behalf of the entire group and collect management fees, and that's a more typical fund structure. So that's where you as an investor would invest in the fund, and the fund will invest in the startups on your behalf, with your money on your behalf. Now, how do investors actually make their money? Now that you've invested in the company anywhere from $5, $10, $15, $100,000, you put your money in, how do you actually get a return if you're stuck to the company and you never get your money out? How does this work? So either the company goes public, so your private shares are now available to, liquidate on the public market. So if we take that Facebook example that I gave, that initial investment for 10% stake, which was diluted by future financing rounds, but still several percent of Facebook, you can go and you can sell those shares. Today they're trading at what, $300 a share? In the future they might be $500 a share. At one point, they were $30 a share. So if you want to stay invested, you can just ride the continued growth of that company, but you can sell at any point that you'd like. And another way that's actually more common for startups that have raised venture capital or angel funding is through an acquisition. This is where a larger company basically buys out the smaller company. We've seen this, if we use the Facebook example, Facebook acquired Instagram, and so Instagram is not, on the stock market, publicly traded company, because under the portfolio of Facebook. And so all the investors in Instagram, they got liquidity, and these can be cash deals or stock deals, and that's how you can basically get out of your investment when the company is acquired in the future. And it can be acquired at a valuation higher than what your initial investment was, or at a valuation lower, in which case you probably won't get any of your money back, or only part of your money back, and you won't see that positive ROI. Another option, which is similar, is private equity. So basically a future investor, or the secondary market, which is developing, it doesn't really exist right now, but basically you invest in one round of funding, and 5 years later, the future investor decides to buy out all the prior investors, and ideally at a higher valuation than when you invested in. And so because of that, you would have a positive return on investment, and it's up to you if you feel that it hit your standards, if it grew enough in whatever time frame it was. That's another option. And then the fourth I have listed here is really not as common, but it is for non-tech companies. If you have a brewery or something like that and you invest, it's revenue share. So as the company grows and succeeds, they will share out some of the profits with their initial investors. This can be done in dividends. This is more common in the public market. You see companies that are wildly profitable or not, and they distribute dividends to their investors. And that's an option in startups as well, but it's less common. Now, where do you find these startups? Before we do that, I'm going to talk about the investment vehicles, because I skipped over that, and this is really important. So when you think about making an investment, we go back to the Shark Tank example. Mark Cuban is offering $50,000 for 20% of the company. That is an equity investment. He is buying shares at a price valuation, in that case, maybe $500,000, $1 million, $10 million, it doesn't really matter. There's a fixed valuation set that is an equity transaction, equity deal. You might have a debt deal. This is like basically a loan where you're investing a certain amount of money and you need it paid back with interest or some kind of revenue share in the future. Then you have something called convertible debt. This is a different type of financing vehicle where basically it is like a loan, and when the company raises a future round of financing, your loan instrument will convert into equity at the valuation of that future price round of financing. I know that sounds really complicated. If you're interested, I'll make a video on that specifically. Similarly, a SAFE stands for Simple Agreement for Future Equity. This basically means the same thing. You're investing into the company at some sort of a valuation cap maybe, and when the company raises money again in the future, your investment will convert into equity at that valuation. So if you invest in a SAFE, which is actually very common in Silicon Valley and online in the earliest rounds of funding, you don't want to set a valuation on the company, so you invest via the SAFE vehicle, and at some point in the future, whether it's 12 months, 3 years, 5 years, whatever, the company will raise more money, and ideally at a higher valuation than the cap that you set, and therefore you will have some kind of appreciation in the value of your investment. Now let's go back to where to find these startups. So There are 4 main channels. Number 1 is these different angel groups. I've mentioned them. You go online. There's tons of angel groups. You can see different startups that are raising. Some of these you have to be a professional investor, which according to the US means you have over $1 million in assets, over $200,000 annualized in salary. And so because of that, that's a little bit more restrictive. However, there are entrepreneur networks, so entrepreneurs, myself included, we're normally plugged in the best because you talk to other founders and you will know before anyone if and when they're trying to raise money. And so if you want to get in on that deal, that's really the best place to look, being a founder yourself and investing in other founders. But if you're just getting started and you're interested in learning more, you can go online. You can look at companies that are doing open public offerings. You can join syndicates on AngelList. I'll link all of these in the description. You can go to Wefunder. I actually raised over $500,000 for my company on Wefunder.com. If you want to check out how I did that, there's a video I did specifically on how we did that. I'll link it in the description below. There's another company called Republic. I've both raised money on Wefunder and I've invested in companies on Wefunder and Republic. So these are great resources. And once you've found a company that you think you want to make that investment in, what do you look for? How do you evaluate if this is a good investment decision? If your friend comes to you and they have a great idea for sliced bread that's going to be delivered by pigeon, is that a good idea to invest in? That is an amazing idea that I just came up with. So if you guys like that, make sure you comment below. What do you look for? The team, the problem, solution, market, traction, finances, and cap table. It sounds simple, and it actually isn't that hard. Basically, you have to believe in the team, the founder. This is true in a public company, but especially true at the earliest stage, because if you don't have a competent CEO or competent founding team that has a mission and they're really passionate about what they're trying to do, everything else doesn't matter. It doesn't matter how attractive the market is, how much money they have in the bank. If the founder, if the CEO isn't motivated or doesn't really know what the heck they're doing, it's not going to work. So you have to believe in the CEO and you have to believe in the problem and solution that they're trying to solve. Does it make sense? Do you understand this market? Is it a big market that's growing and you understand the problem that they're trying to solve? If you don't and you can't explain it to someone else, you shouldn't invest. I believe this to be true in a public company as well. If you don't get what the company does, don't invest. Do they have any traction to speak of? Have they launched a product? Are they making revenue? Are they profitable? Are they doing anything big? Traction is important, and of course, finances. Do they have cash in the bank? Balance sheet is not really as important at this stage, but knowing that some great investors are willing and able to put more money into the company, the cap table is clean, all of these things add up, and they're all super important. Now, before I wrap up, I want to give you an example. Here's a portfolio of someone who has 10 investments. Let's say they invested 10 times $1,000 in each company, and we're going to look 10 years later what happened to these investments. This is completely hypothetical. It can go this way, it can be way better, it can be way worse. I just want to illustrate the power of investing in startups. Let's say you invest in 10, $1,000 each. 5 of these startups, in this example, completely zero. You get none of your money back. The company bombs. It completely fails. 10 years later, you've got nothing to show for it. 50% of your portfolio, just garbage, trash. Now, this was a public account that you're looking at, public companies. That'd be really bad. That's really bad stock picking if 5 of your companies fail 10 years later. But this is startups we're talking about. Now, what about the other companies? Well, 3 of them were actually able to double your investment over that 10-year period. And quite frankly, that's actually not that impressive for a startup. A lot of publicly traded companies will grow that fast or faster in a 10-year period. But you know what? It wasn't a complete loss. We were able to appreciate our value and double our money in a 10-year period. 3 of the companies, that's great. Now, one of the companies really did well, and it 10x'd over the 10 years. Basically, it was able to double every few years in value, in revenue, whatever it is that they were doing, and we got a 10x'er. And our 10th company was able to 20x in value over that decade period of time. Now, again, these are just complete examples, and what I'm trying to illustrate, if you were to average out, what does that actually mean? 10 years later, $10,000 invested in this startup model would equate to $36,000 in value. If you were to invest that same $10,000 in an S&P 500 index fund, over 10 years of growth, averaging about 8%, maybe 2% inflation, 6% average, you'd end up with $17,900. So we're talking about more than double in a 10-year window just by investing in this alternative asset class. Now remember, this is just an example, and very easily, these 10 investments could all return absolutely nothing. Zip, zilch, nada, nothing. And the reason why this is important to bring up is because you can't just invest once in a startup. You can't invest twice. You can't invest, honestly, even 10 times. The best startup investors have put in hundreds of investments. And so in this 10-year window, realistically, you should be investing 10 times per year over that window, so you have 100 investments. And maybe in that 100 investments, you might have something like a Facebook or one of these companies that doesn't 20x, that 1000x's your money in 10 years. And so in that case, you could have 99 go to zero, which really would not be good, but you could have a majority of your investments completely fail and go to nothing, while a few of the investments are the superstars and actually carry your entire portfolio to this type of an insane internal return, which is absolutely amazing. And that is the power of startups. All in the meantime, you're supporting the entrepreneur and you're learning new business knowledge, diversifying your portfolio. It's amazing. I hope you guys enjoyed this video. I hope it provided a ton of value. Let me know in the comments. I can make a video about each of these topics specifically or tie in my own business. Let me know. Thanks again for watching and keep hustling.